world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Aman Ghei and Nigel Verdon. Aman is a principal at Finch Capital, a venture capital firm with offices in London, Amsterdam, and Singapore. Nigel is the co-founder and CEO of Railsbank, a banking utility layer giving fintechs access to banking services in 5 lines of code. Both of these guys have been on the podcast before, and today we take a step back. We explore some high-level fintech topics, which both of these guys bring valuable insight to. We explore a range of subjects, including open banking, proptech, insurtech, platform banking, and more. If you enjoyed today's episode, please subscribe on iTunes or your podcast platform of choice and leave us a review. Connect with us on Twitter at Rebank Podcast, on LinkedIn, Facebook, or YouTube. Thank you very much for joining us today. Please welcome Aman Ghei and Nigel Verdon. Aman and Nigel, welcome to Rebank.
Thank you for having us, Will.
Yep, thank you.
Yeah, well, it's great to have you guys back. So you've both been on, I think, Aman, you've been on twice before.
Yeah.
We did an episode with Alvaro one time.
Yeah.
And then one-to-one, I think,
Yeah.
which was good. And Nigel, similarly, we connected and went through kind of Railsbank and what you guys are doing in pretty good detail. And maybe just to kind of, provide a bit of context as we get going, refresher on who you guys are, what you do, and then we can dive in from there. Nigel, you want to start?
Sure. Again, Nigel Verdon, my background, been here in the financial services technology, both sides, on the finance side and on the technology side for the past 30 odd years. Previously, I founded a business called Evolution, which, when a thing called the internet appeared, helped digitize the capital markets businesses of people like UBS, Goldman Sachs and others, and then was brought in to help turn around the equities business of Dresdner, where I met a colleague, Sean Park, which you'll know from Antimus very well. Sean and I ran part of a business called Digital Markets, and when we both left the bank, he founded Antimus, I founded Currency Cloud, which is a business as you'll be all familiar with. And now I'm the co-founder and CEO of Railsbank, which is a open banking business. We're actually building a global bank rather than an open banking platform, with my co-founder who I've known since I was 13 years old, went to school with, went to university with, and we exited Evolution, that first business we built together as well.
Excellent. Wow, great story.
Cool. I'm Aman. So I'm with Finch Capital, formerly known as Orange Growth Capital to maybe some of you, and I guess that was what we were called when we last spoke. But we're an early stage venture firm based in London, Amsterdam, and Singapore. Sounds like a lot of places, but we're a relatively small team. We invest in kind of anything that solves big financial pain points. And it is generally across industry, across product verticals, and across different types of business models. So we'll look at anything from kind of automotive leasing to real estate, insurance, and then your kind of traditional financial services, lending, invoicing, and so on. Now have made over 20 investments across the board, companies like Trussell and Zopa that maybe people are familiar with. Spending a lot of time in the UK in particular, in certain verticals like property and banking.
Nice. Well, you guys are certainly good people to know at Finch. You were good enough to invite me to speak at one of your events not too long ago. It must have been April time maybe.
Yeah. And we had a bunch of
so many companies were there and some really cool stuff.
Yeah.
Good event. And people should totally check out the newsletter that you put out.
Yeah.
Which touches on some of your portfolio companies and also just the broader fintech world.
Yeah, we'll try and be as unbiased as possible.
Perfect.
But,
Well, and people can subscribe on your website, I guess.
Yeah.
Excellent. Nigel, maybe to kick the conversation off, you could just kind of update us on recent progress with Railsbank. I think I'm stretching my memory here, but I feel like the last time we spoke, you were in the process of integrating with some of your banking partners and kind of in the process of going live. That was a while ago now. You're live in the market. How have things been going lately, and what are you seeing kind of the most relevant use cases being for your customers?
Sure. An update since then, yes, we are live now. We're live across Europe, so in euros and sterling, and issuing accounts again across Europe. We've also just launched our card issuing capability. So that went live literally today. Our first bins went live, and I believe something was bought on Amazon today. So that was a good thing to see.
Nice.
And that value prop for customers is we've got, if they want to do a pilot with cards, we can have something up and running with our card printers super quick and almost get them in business in a few weeks. And that is probably it's a world first able to do that. The other beautiful part of it only takes you 6 lines of code to onboard a customer, issue them a bank account, issue them an IBAN, issue them a card. First of all, you've got to load money on the card, that's 1 line of code, then issue the card, and spend it and authorise it. So it's one of the most simplest ecosystems to actually hook into through APIs if you want to have a full banking platform. So with that, we are live. We've got customers, which is good news. Mm-hmm. We've got the recurring revenue, which is good news for investors and things. Team has grown to 14 in London and 7 in Slovakia. And we're growing in London as well, just taking the second floor in the building we're in to expand out in London as well. So, yes, it felt like a long time ago, but to me that felt like about 5 years ago in terms of emotional time since we last talked.
Yeah. Well, maybe a good place to start is with open banking. So the concept of open banking. We discussed it in detail. I guess it was just 2 weeks ago with Megan Kaywood from Starling Bank, Jamie Campbell from Bud, and Louise Beaumont of the Open Banking Implementation Group. But you guys have your own views. Aman, you'll have seen a range of companies who are looking to leverage open banking. Nigel, you're effectively enabling those sorts of services, and at the risk of being repetitive, I personally make the distinction between the law, the capital O, capital B open banking, the kind of implementation of European PSD2 in the UK, and tech sector best practices, openness in terms of third-party data, open APIs, pulling in feeds, sources of information that didn't traditionally sit within a transactional bank account or a lender's underwriting process to do more interesting things, to make better risk decisions, to create new customer experiences. Aman, given kind of what you're seeing, what you're thinking, open banking.
Yeah, so I think kind of, let's say from a venture capitalists like to sit kind of 30,000 feet above the ground sometimes, but I think from a high level, I think everybody kind of believes in open banking and that there will be lots of kind of businesses that will benefit from the data access that open banking provides. I think what's kind of maybe taken longer than maybe one would suspect is, kind of what are the applications, what are the products that are built around this? And I think you're just about kind of seeing the first wave of products. I look at kind of some of our portfolio companies and I ask them, how are you kind of leveraging this? Because for them, there are two kind of categories, right? Help us make better decisions and help us increase conversions. Because I think people sometimes forget about that, right? So if you think about a flow, and again, this is just a particular product, I look at applying for a mortgage, submitting bank statements. That should not happen anymore. And I think we're almost there with digitizing that process. We're not there yet. But that, I think, is a very important product for a open banking startup or open banking, let's call it middleware layer to have, is to provide these services. I think income verification is probably one that has the credit agencies a little bit worried. So the Experience of the world and Call Credits of the world promise income verification, but in reality, they don't actually verify income. It's based on data they collect from different sources. But if you ask a customer of one of the true layers of the world that are kind of well known in the open banking space as well, and Nigel will know this better, is what they are, the value they're getting from open banking right now is really around categorization, right? So can I tap into someone's feed and see what their income is, but also what is their disposable income? Can you categorize that for me? What are they spending on gambling? If you're a lending product, you kind of need to know that. I don't know, what are they spending on other direct debits? So I feel this categorization element has been pushed through. I'm waiting for some other kind of products to come along the line. I don't know how you feel about that, but
sure. We see the current state of open banking is incredibly nascent. There's two small services that are offered, which is accessing data in your account, and then data enhancement, categorization, all that area, which makes it super interesting. Payment initiation, which if I was a card acquirer, I'd be slightly worried about because it's cheaper, no chargebacks, etc., and the liability still sits with the bank. So, and the credit risk of the merchant sits with the bank, which is great news. But there's so much more. We look at open banking in a set of capabilities, which is issuing accounts, which you currently can't do with open banking. I don't think in any pans. It only works with an existing bank account. We see open banking means APIs to issue bank accounts, to issue addresses to those bank accounts, which are called IBANs, PIN numbers, SUN numbers for direct debits, to issue cards that work on those accounts, to receive money from all the different schemes, whether it's SEPA, Faster Payments, SWIFT, even from card transfer, send money by those schemes, collect money by direct debit, etc., and convert money, foreign exchange, manage beneficiaries. All those we see as the whole gamut of open banking APIs. And that's where we focus our real energy, because the PSIP and ASIP services, I think people like TrueLayer have done a phenomenal job. And also you talked to Jamie recently, and Bud are doing something interesting over there, to be able to leverage somebody who's done something good in that area rather than trying to reinvent it ourselves. But we focus on everything else that's not covered by the just the PSIP and ASIP capabilities.
Yeah. And people always forget about that, right? Everyone focuses on data, like what is the data you can extract, how valuable it is, but I think people forget about what about all the different financial products that open banking can kind of provide, right? It's
if you look at some really, really, really actually boring areas, which I was about to say exciting, will excite me anyway. Accounts receivable, it's the most boring process under the sun. But imagine if you can assign IBANs to each of your customers, so when money comes in from them, they have their dedicated account. Your reconciliation is almost instant. And if you've got instant reconciliation, a time from money arriving to booking on accounts is normally about 2 to 3 weeks. So you can suddenly free up 2 to 3 weeks of working capital, and hence your ability as a company to operate more efficiently is there just by doing one simple thing of issuing IBANs to all your customers so they can send money in from an invoice. So then you take it to the next stage of imagine doing payments initiation with the invoice and your dedicated IBAN. You've got your credit risk has gone down massively on there. You don't have all the issues you have with direct debits, with clawbacks and the 2-year clawback, etc., and those type of schemes. So there's some fairly boring processes that are quite exciting to us, and use cases that can be solved if you bring all those different pieces together and then give them to customers as APIs, and they go and solve those processes. And we were all just talking earlier on about the sort of prop tech business that's sort of emerging, primarily a lot driven out of London as well, of again automating the receivable side of landlords renting out, so rent collection, rent attribution, or categorization is another way of saying it, and then automating that whole process, so you don't have lots of people booking the money and sending the money all over the place, because you've got the money coming in, you've got the managing agent paid, you've got the service agent paid, you've got all the different people paid, the landlord taking his cut and others, and you've made a much more efficient, less error-prone process for the landlords, and that means landlords can do things on scale as well. So it enables scalability. There's a great business in East London called Good Lord who are looking at that exact use case at the moment.
Well, anything that makes property rentals either for renters or owners easier, I think would be very welcome in certainly in a market like London.
I think a lot of people don't know. So I think come next year, I can't remember the exact month, but the government is abolishing the tenant fee that real estate agents charge tenants. And that is kind of generally 15-20% of a real estate agent's revenue. And that could be quite fundamental in terms of they have a decision to make in terms of do we optimize our cost base, which is do we have a lower cost base, fewer people? Do we improve processes so we do more tenancies more efficiently? Or do we buy software that helps us cross-sell different financial products? So that part is, 20% of your revenue is quite significant if you're a real estate agent. And most of them are kind of, 1 to 5 person agent branches typically.
Wow.
Yeah.
That's going to be quite a change.
Yeah.
Quite a change in the industry.
Yeah.
Aman, you mentioned you were doing a bit of work in prop tech at the moment. Is there anything else that you're looking at?
Yeah, lots. I think I didn't realize how important and kind of how many different financial implications the industry has. So I think we've all looked at mortgages and said, yeah, that's obvious. That's a clear problem. How can we get you a better mortgage quicker, more efficiently, and so on? And then we're obviously in Trussell, which is a company that's doing that. But there's so many different parts of the value chain that are still to be kind of tapped into. So an interesting concept that I'm seeing in the UK as well as in the US is this thing around deposits, right? So if you've rented over here before, you probably know that you need to give 6 weeks deposit as rental, and that's basically anywhere from kind of £2,500 sitting in this government-backed TDS account doing nothing for you. And so we're seeing a lot of companies come up in that space trying to say, how can we kind of leverage that, whether it's from an investment product perspective, offer landlord insurance, and so on. So that's an interesting kind of element to it. The other part that I think is probably being more broadly addressed, but not specifically, is really around legals. So if you think about tenancy in particular, tenancy application is fairly straightforward. A tenancy legal document is fairly straightforward, and a company like Good Lord, for instance, as Nigel said, can kind of automate that process pretty quickly. What happens on the when you go to buy a property? The first thing you have to do is pay $10,000 to a solicitor to start drawing up a contract. That should not happen, and so we're spending a lot of time in that area trying to figure out what's there. And then kind of just to excite people, I think we've started looking a lot at kind of the crypto asset class related to property as well, right? So I think if you look at cryptocurrency in general, if you think of it as an asset, which I guess most kind of economically astute people do, trading asset, it's a fairly volatile asset. And suddenly you have a lot of retail investors that own this volatile asset and are looking for different asset classes to invest into, whether that's shared ownership or not, but they need the vehicle, call it the Coinbase or whatever for property, to be able to do that. So we're actually seeing a lot of kind of momentum in kind of this real estate tokenization element as well. Now, I don't know how long that's going to be lived for, and again, with crypto, it's one of these things that could be up one day or the other day, but the whole idea is a crypto investor from fairly volatile asset class wants to get into a fairly stable asset class using his assets. Can we provide him the exchange or whatever to do that?
Speaking of prop tech, I was hanging out with a friend of a friend just last week, a guy named Matt Robinson, who started a company called Nested. Which is a fascinating concept. It's basically, you own one home and you're trying to basically sell it and buy a new one, and your money's locked up. They have these horrible things in London called chains, where you're basically the person 6 links on in the chain can't sell his or her property until the 6 prior transactions have completed, and so they're looking at creative ways of basically unlocking people's cash from one home so they can put a deposit on the next one.
Nested is fascinating, and I think like a lot of people have kind of gone and copied that model all throughout Europe. It's actually addressing a very important pain point in the UK market, right? That
it's a huge pain point.
Yeah,
anybody's been stuck in chain.
Oh, it's a nightmare.
Properties dropped out because of that, and everything. I experienced it as in, like everything, you always think in the customer's shoes, rather than what you think, if you see what I mean. Back in 2003, when we left the UK, we went to live in France at the time, and trying to sell our house, perfect buyer, but they couldn't sell their flat because another chain had dropped out. So we bought the flat, almost in part exchange for the house. So I ended up with a flat in London, which was a good investment at the time, because roll on 10 years when we sold it was actually quite a good investment.
Yeah.
But it wasn't an intended investment. But to get the transaction unstuck, we had to put more capital than we really wanted to on the table, and took more financial risk as a family. But it's a real problem on there.
But that's solving like so many fundamental issues of a real estate transaction, right? Because it takes today 60 days to complete a real estate transaction, when it should not take 60 days, right? And if you think about the smart stuff that Nested and the others are doing, is really around kind of leveraging kind of registrar data, valuations, applying technology on how quickly can we get a valuation that we're pretty comfortable with without sending a surveyor across the board, which is where the bottleneck is, right? And then I think that you have to kind of trust them to be able to turn that around and sell it. The trick, I guess, the big question mark about these models is really kind of what happens in a
market dislocation, exactly,
or a crash, right? What happens in these extremes, right? Can you turn over the inventory quickly enough, or the other way around? Is the supply demand so elastic that people feel that they can kind of quickly get that turn over their property themselves and kind of don't need you? But I think London's pretty developed and maybe doesn't go through those extremes, at least.
Although if I presume they must have somebody who's run the crash scenarios from a risk side in Nested. So if it does crash, generally rentals go up.
Sure.
And so you may be sitting on an asset rather than sitting on
good yield.
With a good yield.
I think there's a material adverse change clause in their contracts also, where if there's just a complete bottom falls out of the market, then I think there's some leeway there. But
you still have an asset, which is better than not having an asset.
Because this whole, just following on from the crypto side, is if you've got a tokenized asset, whether it's a property or something else physical, or value you can touch and things. One of our customers is launching a gold current account to use and spend. So the spend is actually converted in real time on the gold current account.
Interesting.
What's it called?
It's Gold Block, as it's called. It's actually our lead investor in my last round is a gold mining company, and they're doing gold mine to gold spend, and that's why we're part of that value chain from the ground out. So like BP controls oil from the well all the way to the fuel pump. It's a similar sort of business model of owning value chain.
Wow.
But the key thing is their proposition is this is an asset you can exchange with people.
Yeah.
But it is actually backed by something in transit as well. which is called gold, which is over the past 20 years has held more value in deposits than cash deposits, for example.
Yeah.
Interesting. Aman, you were saying before we started recording that another area of interest of yours at the moment is next generation insurance business models. On-demand insurance, collaborative, risk sharing. What are you seeing in that space?
InsurTech. Interesting. So I think we went through this wave in kind of 2014 through 16, probably, where InsurTech was a big thing, right? And everybody wanted to disrupt insurance and be the next broker, and very quickly kind of realized, and we were also victims of it. It's very hard to disrupt an insurance company because of the economics in general, and I think banking's a little bit different, and maybe you have a better sense on that. But with insurance, like for me, insurance underpins the world we live in, and as a result, you have to be very particular around having enough capital, having the right reinsurer relationships, and so on. And then kind of the startups quickly realized that, we cannot go out and build our own insurance company. Obviously, there's some that are doing it and doing it well. I don't know the numbers exactly, but the Lemonades of the world and so on.
Trove.
Yeah, Trove. But in general, none of them are still making money, which is still the scary part. But in general, I think you've seen the shift towards reinsurers, people who kind of insurers sell their risk to. Warren Buffett, for instance. I think a lot of people don't associate reinsurance with Warren Buffett, but Berkshire Hathaway is the biggest reinsurer in the world. Great cash businesses, right? They are sitting on tons of money that they need to deploy. And I think what the startups have now realized in the last maybe 1.5, 2 years is we need to actually go to these guys and give them a platform to deploy this capital. Because they want, for a reinsurer, it's all about spreading out risks with magnitude. So if you go to a reinsurer and say, hey, can you put up 1 million over here? They're not interested. Can you put 50 million here? They're suddenly interested. And then when you open up these different business models, so whether it's on demand, kind of bike insurance, the gig economy insurance, they're willing to kind of part with capacity to try these different things. And I think it's kind of a win-win for the startup, as long as they kind of think about provisions around how exclusively they're tied up to this reinsurer and so on. But I think at least for the next 2 or 3 years, you'll see a lot of focus in this segment of the market. I don't know if you have clients in the insurance space, but
I've got colleagues in this space, and I remember Trove when they first started, as such a different business model than it is today, because they're an Entimus investment. But there's some colleagues of mine in Sweden who've got this company called MyDrive. It's the similar model that was done in California, where you've got a little box in your car and it sends data to you, and you drive better. And they made the decision not to be the broker, but to work and own the portfolio, and to try and find a reinsurer essentially works with them to be able to carry the risk and things, and to pull your capital through them. It took them 2 years to actually get the risk carrier. And so they've worked out that the real value in the insurance is the data is just something that enables it. And they can they're looking at other things of like house insurance, where the fire alarm and burglar alarms and everything communicate with you. So you use that as just data points for pricing and for portfolio management, etc. And then the real money is in the portfolio itself.
Yeah.
Managing that portfolio of drivers or homeowners or whoever. And the money is exactly as you said a moment ago. It's in the money, as opposed to the tech is just a way of originating customers and getting the data to be able to price and risk manage and underwrite.
Yeah, and like if you originate, like you get, I think kind of general commission rates are like 15, 16, 17%, whatever it is. Can you build a big business? Can you build an interesting business? I'm sure. Can you build a big business? I don't know. But I think as Nigel said, the real kind of trick here is to kind of manage that money and have skin in the game with loss ratios, right? Because if you're just passing on this risk to a reinsurer, then if you're underwriting great, if you're finding great customers, the reinsurer is benefiting because their loss ratios are low. So you have to have kind of belief in that. And then on the kind of front end side, I think you've seen some interesting stuff, particularly around kind of the gig economy, right? Everybody, it's. I think what's interesting for reinsurers who provide the capacity is it's a category that no one sells into, so it's generally a uplift in the gross premiums they write, and that's what excites them, right? I think if you look at auto, for instance, the on-demand stuff in auto, the insurers are a little bit nervous because today I am paying whatever it is annually for my auto insurance. What if I change that to a more on-demand thing? Yes, for me as a customer, great. But for the insurer who's underwriting it, does that mean his premiums are actually falling?
That was exactly because I was pressing my colleagues over a few wines. I mentioned beer earlier, but over a few wines. So next time we've got to have wine.
You got it.
And the same. Look, one of the big insurers in Sweden and Norway and Denmark just come and attack you.
Yeah,
is exactly that reason. They're very happy.
Yeah.
Where they are at the moment, and one of the fears is, can we sustain dropping premiums by using data ourselves? Probably it's too scary number within the organisation.
Yeah.
I haven't done the maths on it, but that was a colleague Anders' argument was, we can build a good business on here. We can then expand it out of the Nordics into different countries that insure cars by the car as opposed to the individual, which is like the UK. So France, Germany, etc. insure the car. But there's big markets where their model can work.
I think there's an interesting market in some of the more like niche players, right? So there's this company, I think it's called MyDrive or MyDrive. I don't know if I'm pronouncing it right. But essentially their focus is really around student drivers, right? So they acquire you when you go to like driving school or when you go to get your test. And as soon as you pass your test, what they found out was actually 60 to 70% of the drivers never end up driving for another 3 years because of the massive insurance premium hit their parents have to take. And then they go to the insurer and say, hey, there's this massive market here that is not buying premiums. We know everything about them because we technically inserted ourselves in the flow when they were training. So we know their score, we know how many hours they train for, blah, blah, blah. And then they provide them kind of the outlet to get an insurance policy that is, in theory, kind of more practical for them.
What market do they operate in?
So like, I would say they focus on kind of student...
No, I mean geographically.
UK.
Yes.
UK. You might have seen, like, they brand their cars around. So I don't know how much they are in central London, but definitely outside. MyDrive. I thought it was quite interesting, actually.
That's another serious pain point because the pricing of kids' driving insurance is insane because of... But if they, like everything, using decent data to skew your risk profile to those ones we like, therefore can we leave that to the tradition?
Yeah.
It's an interesting model. I think my eldest daughter is going to have to be pushed that way.
Yeah. No, their whole thesis is, we're technically a driving school, and you have to pass these amount of tests. And okay, I think they might have a device as well, but at the end of the day, they promise you an insurance policy that you might not have got. 60, 70% of people don't get, and 30% that do pay crazy amounts. So, yeah.
So another point I wanted to pick up was, Nigel, a report that you sent me over the past few days, put up by QED, the venture capital firm, not too long ago. I think it was published in April, and it basically talks about how white label banks will rule the world. Excellent reference to Railsbank in there. Congrats on that. But I mean, I think the concept totally resonates with me, which is basically that right now you've got thousands of banks that all kind of attempt to offer all products to all customers, and what you'll eventually end up with is
specialists in specific products, specialists in specific segments, and a handful of kind of back-end providers at scale who are powering those front ends. And Nigel, maybe you want to pick it up because effectively that is Railsbank's model.
Sure, it was born out of just pontificating over with my co-founder a little while back on current accounts have no value whatsoever, and while everybody tries to market them as something, my current account's better than yours, they aren't. It's a current account, and a deposit account's the same thing. It just sits there and holds money. And if you start to believe that this should be a utility, why should every bank carry the cost of running current and deposit accounts? But why should they focus on areas where they're amazingly good at? And they used to be edged. The whole issue is banks became so broad, they became so bland. And hence what is meant to be an innovative product, which I love banking awards, the most innovative current account, is not that's the most incremental innovative current account is not sort of thing that there shouldn't be awards given for it. But if you roll it on theoretically, banks can concentrate and shift part of their cost base into utility and white label, because running a current account is a fairly boring process. Capital markets do it, and lots of things called clearing, they do it, and things. So there's utilities that the capital markets use. There's utilities that other markets use as well. There is the concept then of a utility bank, or one or two of the big commercial banks having a new P&L on the bank called utility banking. And that is a pure, we basically white label our balance sheet and protections and everything out to you. You operate your bank on top of it, or your financial services. So, and once you recognise that, if you make everything that is just boring, which is sending, receiving money, there's no advantage in a faster payment being done by Barclays or a faster payment being done by HSBC. There's different credit risks, but your consumer doesn't give a hoot, to be honest about that, especially if it's small payments. Why can't there just be a faster payments utility run by the Bank of England? It is run by the Bank of England, but if they white labelled out to everybody else, you didn't have to have so much infrastructure yourselves to operate it. Card issuing, there's nothing. It's everybody does it. There's different features on the card, and that's the bit that gives you edge, and different risk profiles and risk products you put on the card. But issuing a card is a utility. It's a commodity item. So the QED guys, Frank over there, massive respect for them, because I think Nigel Morris and his colleagues built a colossal business, and they happen to be really humble, decent individuals as well, which is even better. They've been thinking through this whole more platformification of bank, and I hate the word platformification, but when you've got utility and then you've got platform on top, then you've got access. And if you look at what Tencent have done, and I met Tencent through you guys originally, what Tencent have really done is, in the Chinese market never had retail banking, but Tencent and all the large companies over there understood that my customer wants to do all sorts of things through my app. So WeChat is how you interact with a customer. Banks, I think, need to get over the mental leap of let other people interact, other apps interact with you, which is like UK Open Bank is pushing, because the customer lives their life in other apps. They don't live their life, and they don't want to go into a banking app to do something. They want to be on WhatsApp or whatever and just say, I need to send my buddy some money, that's it, and done. So that utility layer, that platform layer, so Google is your interface to life for all sorts of stuff. You just got your Google bit and it's connected to your bank, and off it goes, because it is a utility. So where banks can help you in life, it's more about planning your financial life, helping you be safety of storage of assets, which is banks are massively important for that role. Their brand is hugely important. If something goes wrong in the world, HSBC's deposits go up like this. even if people don't like them. The deputy CEO is one of our investors, so he said, yeah, we love it when the world goes wrong because our deposit base goes up rather than flight safety. There is lending, which is what the purposes of banks originally were since when they first invented.
Still are.
And good lending products and focus on lending well and understanding the customer rather than this computer says no thing, where a computer can be much more smarter to understanding and help. If you blend that with the sort of what Handelsbank have done, which is a sort of high touch, as well as also some decent sort of tech in the background, you've got a bank that can actually deliver service to customers, and that's what you'll win on, not the best banking app. Because the best banking app can be copied, and you don't want to live your life in it. Now, there's interesting guys building into their banking apps or the neo banking apps lifestyle stuff like coupons and all sorts of stuff, but it's just, are you going to win millions of customers because of your coupon piece? But WeChat has billions of customers already connected. Why not just use them as distribution and then focus your effort on much more higher margin and things that help the customer's lifestyle and financial life?
Yeah, I was actually I was talking to a massive multinational bank recently, and they were basically in the process of at least one team within their organization building a platform layer for their own bank to basically feed via API all of their various local country banks. So they're present around the world. Why should each country have their own core banking? Why should they each have their own systems? Why should they use local installations of this the same splintered off the original? Just a mess, right? So why not just build a platform and pipe every product, at least core products, via API, and obviously you can do some local market kind of tailoring. And then why stop there? Why not offer? Okay, great. So they built the current account, the API current account. Why not sell it to other banks as well? And so there are people thinking this way. It's actually great to hear such a large bank thinking about it like this. But you guys like Nigel, you're years ahead of them.
We're just doing it a slightly different way because we're actually building a competitor to HSBC and Citi. Because if you look at fundamentally what I don't mean to pick on HSBC, it's just a good example, everybody knows, because they are a good bank, is 50 legal entities with 50 banking licenses, about 40 different systems and platforms on top, not super interconnected, customers known by different things and all over the place. To do a fraud investigation, you've got to take a couple of months of doing data analysis to get the data to do the investigation. So we thought, well, if they do it that way, why don't we just get a bank in each country connected over to Railsbank, common idea of who the customer is, and we can just simplify that layer using existing infrastructure. That's what we're going out to build. So instead of having one logo and 50 banks and HSBC and all those branches, we'll have one API and our logo on top of that, with 28 banks to deliver global banking through as a platform, and also without the capital heaviness of having to manage a bank in each country. We'll use the licenses of the bank in each country.
I was going to say, I think over the course of the last 2-3 years, we've seen obviously a lot of startups come in with this kind of neo-bank pitch, whether it's business banking or the Monzos of the world or whatever it is. For me, the critical thing I ask is, are you the primary account, right? So if it's a personal account, is your user's salary, not a deposit, is their salary being paid in your account? Because for me, that is fundamental, and that's actually what the incumbents are so good at. And the reason they're good at, as I think Nigel was saying before, was people trust them at the end of the day, right? It takes 10 decades to build trust, right? So you just can't build trust overnight. And I think the big question banks have now is, look, we've built this trust, it's not going away. We spend billions and billions a year on securing people's information and securing money that no startup can ever come close to. what we are struggling with is on the cost base, particularly on the origination side and the efficiency side. Is there a way for us to leverage our trust, leverage the ability that people trust us and we secure their information and we have deposits, and actually do more business? We have white label solutions. I look at it kind of this way. Why do banks not touch SMEs? Like, this is like let's say like lending. Why don't banks touch SMEs? The only reason they don't touch SMEs is it's too expensive for them to process them. Not because they don't want to lend to them. They don't want to lend to them because it's too expensive to process them. So is there a way they can maybe, I don't know, silo their part of their balance sheet for that, or use white label solutions to be able to kind of access that market? And maybe it starts with this market, then it moves to another market. I just feel they need to kind of strip out a lot of the fat, so to speak. Focus on what they're good at, which is trust at the end of the day, and deposits. Like, people want to put their money or want to have their salary paid into their account because they trust it's not going to go somewhere overnight. So that's, for me, is like the fundamental thing. And I think people like banks are going to disappear. They're not going to disappear because it takes 150 years to build trust. The question is really, can they be more efficient? Can their cost to income ratios, which is what shareholders publicly look at, improve? Because right now they're at like, whatever, 25-30%. In the
they
heyday.
Would love if they were 25-30%.
A good bank.
Like 50-60%.
Yeah. So good banks are like 25-30%. That's what it needs to be at, right? And that can only happen if you don't want to do everything. It's very important, this idea of focus. And I think sometimes when you get too big, you kind of want to do everything and lose focus on doing what you're actually really good at. And I think banks just need to figure out a way to leverage that. And they're not going away.
Well, Nigel, to your point before about a deposit account is just a deposit account. Why does everyone run their own? Big banks have super low funding costs as a result of their scale and as a result of that point of trust that Aman's talking about. Then you have small banks who have high funding costs because no one knows them. They have to pay more for deposits. Yet they're the ones out there originating loans to SMEs, doing the legwork when it comes to actually originating deals that don't flow straight through the computerized go or no go decision engine that a lot of the big banks use for smaller ticket loans. That to me sounds like a perfect marriage for the right innovative thinkers to put together low funding costs from these massive organizations who in many cases are trying to deter the customers from putting more deposits with them, because the last thing they want to do is just hold a bunch of cash on balance sheet they're paying interest on when they're not necessarily staring at tons of opportunities in terms of deploying it on the asset side. There's definitely an opportunity to do something there.
No, that's so right. Both of you, if you got the capital and capital in a safe place, and then you've got originators and asset or loan originators, because that's what we sort of see the fintech world in. Their superb acquisition costs, marketing, etc. And if you match that up of a large balance sheet with essentially a portfolio risk sort of model on the front of it, and then matching engine that matches that portfolio risk to origination. If you can get to the trust in your models working together, that's a perfect model, because you can even be the warehouse of it. Some of the portfolio management, because I think banks are very good at running portfolio management of a risk portfolio, and they're using a set of originators who know the market and know customers for that segment. And that also works on the retail world, where we did numbers with a colleague of mine, Viraj, who runs a company called Pocket, that focuses on the.
We've had Viraj on the show.
You've had Viraj,
Yeah.
cool.
Good friend.
Yeah, okay. And they, the one number that stuck in my head when I first met him was 8 million unbanked in the UK alone. And targeting on that, the key issue is I think G10 cost of account acquisition or customer acquisition is $350 and lifetime value is $250 without lending. So why does a bank bother to focus on this in the hope of we can get a high margin product to them, which is down to the cost of it of running current accounts. Whereas if you've got a fintech company in front, you can get the acquisition cost per account rather than customer down to around $10 to $20 and lifetime value to the bank of around $60 to $80. And then the economics start working, and you say, right, you bring me that under utility, which is the economic basis of Frank's paper on the Copernicus moment. And then if there's higher margin products, that's where you start acquiring them directly as customers, that they're already talking, and if you've got the right origination agreements with your fintech friends, as you might say.
Guys, lots to take away and think about here. This was excellent. Nigel Verdon and Aman Ghei, thank you very much for joining us today.
Thank you very much.
Thank you. Thanks for the invitation. Pleasure.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.